Hello, I'm Christine Waldron, the Chief Global Strategy Officer at U.S. Bank Global Fund Services. I'm joined today by Jumana Poonwalla, our Chief Program Officer for U.S. Bank's LIBOR Transition Office. Today, we just want to begin by taking a look at what LIBOR might be replaced with. The Fed Organized Alternative Reference Rates Committee, or ARRC, selected the Secured Overnight Finance Rate, or SOFR, as the preferred alternative reference rate for USD LIBOR. Jumana, can you help us understand the key differences between LIBOR and SOFR?
One of the key differences really between LIBOR and SOFR is that LIBOR had a term structure where you would see 1 month LIBOR, 3 month LIBOR, etc. However, SOFR is essentially an overnight rate. And in order to get to a 3 month, 6 month related term structure, SOFR has to be compounded over a 30-day or 60-day period. Two other differences that we should highlight is that SOFR is a secured rate. Essentially, this is your underlying repo markets where cash is exchanged against US treasuries, whereas LIBOR is essentially an unsecured rate where banks can borrow in the interbank market on an overnight basis. The other difference that arises here is that there is a credit spread which reflects the cost of borrowing for banks in the interbank market, and this is absent in SOFR, which does not have this credit sensitivity element included in it.
Well, I know, Jumana, a lot of work is being done, certainly in this space around SOFR and how it works in the compounding. A lot of the systems are being enhanced. But can we maybe switch gears a little bit and talk about some alternative rates to SOFR? And while we fully expect that the bulk of positions and market liquidity is going to transfer to SOFR from LIBOR, what are some of the alternatives that you're seeing out there?
When we move away from LIBOR, we're likely going to move not from one rate to another rate. We're probably going to move to what is going to be called a multi-rate environment. Aside from SOFR, which we've already discussed, you have your prime rate. This has often been used in the credit card market. And there are certain clients that are showing interest in maybe using prime. Other rates, of course, there are clients that have expressed an interest in going to a fixed rate given the low interest rate environment that we're sitting in, certainly for a near-term loan. And that's another alternative under consideration. You also have something that has been around in the financial markets for a long time, your Fed funds effective rate, and we certainly have had at least one nonprofit suggest that they'd rather use this rate given the complicated computations associated with SOFR. And finally, we also have Ameribor. This is a new rate that has come into the forefront in the post-LIBOR transition environment. It's based off of the American Financial Exchange, where you have primarily smaller banks that are listed there. And the small banks have expressed a lot of interest in this as it reflects their cost of funds. For the larger banks, however, this may not match their cost of funds. Given that we expect this to be really a multi-rate environment post-LIBOR transition, there's room for other alternative rates as well over the coming months to develop.
Jumana, thank you for your time today. And we will continue to monitor all post-LIBOR benchmarks, as well as share industry and regulatory changes with regard to the LIBOR transition through our LIBOR communications.
We would encourage everyone to check out U.S. Bank's LIBOR website. You can also learn more about the transition on the ARRC's website, as well as the Financial Conduct Authority. Thanks for watching.